Hello, this is Corner Invest. Today I'll be talking about when I'll be buying all these stocks again. So in today's video, we'll be covering a few things. We'll be covering my buy entries for all my core positions, Warren Buffett's opinions on timing the bottom, as well as questions and some comments that you guys have left in the comment section. So this is my investment philosophy. I own high quality compounding machines that will compound intrinsic value over time. I don't want any junk stocks, no low quality, unpredictable hype stocks. And I don't want to fall in love in any single stock. Sell the stock when the fundamentals change or the competitive landscape changes. So this is what I try and do whenever I'm trying to sort out my portfolio. As for my core holdings over here, these are my core holdings. So I have Visa, MasterCard, Amazon, Microsoft, Google, ASML, MSCI, S&P Global, as well as some Singaporean stocks that I own from when I started investing. So the first stock that I'll be talking about is Google. Google has been hit very hard. I mean, it is now around 30% from all-time highs already, currently trading at around 20 times earnings before the earnings. So this is the S&P 500's valuation over here. S&P 500 is trading at around 21 times and Google is trading at around 20 times as well. So Google is a high quality business and I do believe that Google deserves a much higher multiple as compared to the S&P 500. It doesn't deserve to trade at a valuation that is similar to the S&P 500. In fact, it is probably in the top 10, top 20 businesses out there in terms of business quality, and so it shouldn't be anywhere near this multiple at all. So for Google's intrinsic value, I have it at undervalued range around $160, which is the price that we've been trading for the past month or so. Fair value at around $180 and overvalued is above $200 or so. So for Google over here, it is criminally undervalued. It is a stock that no one loves. The sentiment is crap, and that's why I've been heavily buying into it over the past few months. I've added all the way down from $180 all the way until around $139. That was the lowest point where I added into this stock. And yeah, let's see where this one goes in a few years' time. This is a high quality business that is trading at a very reasonable discount. And that's why Google for me, it's one of my core positions. Next one, Amazon. Amazon is a stock that is currently trading now at around a 33 times price to earnings, and Amazon at all-time highs was at $240 a share. So this is Amazon's margin story over here. In 2024, they improved their margins by around, I think they doubled it. So from 6.4% to around 10.8% operating margin. And portions without AWS, they managed to double it as well. So from 2.7% to 5.4%, I think the margin expansion story is still very much achievable. So why exactly did Amazon's earnings become negative in 2022? So if you were to dig into the numbers in 2022, as you can see, the cost of sales, they didn't go up a lot. The problem was they were trying to build out all the different fulfillment centers. So if you were to look at the numbers itself, they increased their fulfillment center cost from $58 billion in 2020 to $85 billion in 2022. And because they have extremely thin margins, that led to negative net income in the year of 2022. But I don't expect this to happen again because AWS now makes up a large portion of the entire business. And so even if the margins for the retail segment start to drop, AWS will make up for it for sure. So for Amazon over here, this is my intrinsic value. My intrinsic value for Amazon is between $190 and $200. That is around the fair value range. As for the undervalued range, is around $160 or so, which is where we've been trading for the past few weeks or so. And the overvalued range is around $220 and above. So for Amazon over here, it is currently now trading at one of its lowest price to operating cash flow multiple in almost a decade. And so I do believe that Amazon now presents a very good opportunity if you're looking to buy into this stock. It is an extremely high quality business that is trying to steal market share from every possible avenue. They're venturing into media as well. They venture into healthcare as well to steal some of HIM's market share. So I do believe that Amazon it's a business that you can own for the next 10, 20 years or so for sure, unless the internet goes to crap. Next business is Microsoft. Microsoft over here is currently trading at a 31 times earnings, and as of recording, it is trading at around $385 a share. So for Microsoft over here, I think it is the widest moat company in the list so far. So if you were to compare Microsoft with Amazon and Google, I think Microsoft is the highest quality business out of this three over here. It is the most durable business. It is a tariff resilient business because they sell software, and it is recession resilient as well. So look back at 2020, for example, during the COVID year, Microsoft's revenue grew in that year. Look back in 2022 when we had a near recession as well, Microsoft's revenue increased in that year as well. So it is an extremely durable business, and that is why I'm bullish on Microsoft. And for Microsoft today, this is my intrinsic value. I have it at around $380 as the fair value, between $380 and $400. And for the overvalued range is around $450 plus, which is where it traded at its all-time high value. and the undervalued range is around $340. So for Microsoft today, I think it is presenting a decent opportunity. Of course, this stock won't give you 20% returns or so, but it will likely give you outsized returns, maybe slightly above the S&P 500, which is what I'm trying to achieve anyways. So that's why Microsoft is also one of my positions that I have in my portfolio. I'm looking to increase my position size in Microsoft. Hopefully it drops below 340 so that I can continue adding into this one. Next one is ASML. ASML is just an absolute monopoly. I've talked about this a lot already. I have quite a sizable amount of my portfolio in ASML, and for ASML, I think it is just criminally undervalued at this point. Although there are risks with this stock because it is in the semiconductor industry, it is an extremely cyclical business. So we could see ASML dropping all the way until $400 if an actual crisis actually hits. But for ASML over here, the undervalued price that I have for ASML is around $600. The fair value is around $750 based on their projections for 2025 as well as 2030. And the overvalued range is at around $1,000. The all-time highs for ASML is around $1,100, so it is currently now around 50% down from all-time highs. Maybe this is price anchoring, but for ASML over here, we're not buying the stock at a very high price point. And I don't see a reason why a monopoly like ASML should deserve a 25 times multiple. It should be closer to 30 or 35, and that's why I'm bullish on ASML as usual. Next one is Visa and MasterCard. So for Visa over here and MasterCard, these two are just toll gate businesses. They're extremely high quality business. You just buy it, hold it, and then you just don't do anything for the next 10 years or so. So for Visa over here, my fair value is around $300. My undervalue range is around $250, which was where it hit last year. I started my position somewhere there, but it was a very small position that I regrettably didn't add enough. And for the overvalued price is around $350, which is slightly closer to where it's trading at today. So for Visa today, I think it is around 10% overvalued. Next one is MasterCard. MasterCard over here, it is a lot more fast growing as compared to Visa. MasterCard is growing at around 15% in terms of its EPS. Visa is closer to 12. So for MasterCard over here, it is trading now at around a 35 times price to earnings, around a 30 times forward earnings. So for my fair value for MasterCard, it is normally around a 30 times earnings. So it's around a $500 intrinsic value. The undervalued range is around $450. That is when I'll start scaling into my MasterCard position. And as for the overvalued price is around $560, which was where it traded at a few months ago when it went to all-time highs. So for MasterCard, again, it's a high quality business. I'm looking to increase my position in these two companies. Hopefully it gets there someday. Let's see where this one goes. Next one, MSCI and S&P Global. So for MSCI over here, it is a stock that is currently now undervalued, slightly undervalued for me. So for MSCI, the fair value for it based on a discounted cash flow calculation is at around $550, and the undervalued range is at around $500, and the overvalue is around $600 to $650. So for MSCI, it is a high quality business. It owns your MSCI World Indices, MSCI Emerging Market Indices and all that, and they don't do anything, they just license out their indices. And so it is a capital light business that will just keep compounding over the next few years at around 12 to 13%. So extremely predictable business. That is why it is in my portfolio today. Next one is S&P Global. S&P Global, I do believe, is undervalued today. My intrinsic value for S&P Global is at around $520. So even today, it is currently trading now at around $470. I still think it is undervalued, and that's why it is quite a chunk in my portfolio today. But for the undervalued price, I would like it to go down below $440. That is where I'll really scale into my position. As for my overvalued price, I think it's at around $600. S&P Global over here, it is a cyclical business because your ratings portion is tied to interest rates. But with interest rates projected to come down, this will be a tailwind for S&P Global, and they have a very reliable data side of their business, which will just keep growing at 10% or so every single year. So for S&P Global, another high quality business that I would like to own. Last portion will be my Singapore holdings. So my Singapore holdings are mainly just the REITs that I invested when I started out investing at the start. So for REITs over here, most of them, they are undervalued. So I'm not looking to sell them now because they're undervalued. There's no reason for me to sell them. But they don't fit my investment criteria, and if they go back to fair value or maybe even overvalued, I'll start scaling out my REITs position into Singaporean banks because the banks are much more higher quality as compared to your REITs. If you're an international viewer as well, some of the Singaporean banks are extremely high quality. DBS is one, OCBC is another one, and UOB is slightly less quality because they're more subjected to interest rates. But overall, the banks in Singapore are extremely good. You can look into it. They give out quite a lump sum of dividend as well. And the FX effect for Singaporean stocks is not as much as all your different other countries because Singapore, they have a band. They control the band according to the US dollar. So it won't be affected as much as maybe investing in Europe, for example. So next portion over here, I'll be talking about timing the bottom. So timing the bottom is extremely tough. Everyone tries to do it because they don't want to catch the knife, but more often than not, it is better for you to just buy every dip on the way down. So for example, let's say if you were to look back at COVID, for example, if you bought every single dip in the COVID crisis, you'd be laughing today. Same thing in 2022 when we had the dip. So timing the bottom is tough. So this is what Warren Buffett had to say about timing the bottom.
And I am from New Jersey. My question is on market timing. You have always said that it is impossible to time the markets. Yet, if you look at your track record, you have had amazing timings with some of your key decisions. You got out of the stock markets in 1969-70. You got back in 72, 72, 74 when the markets were really cheap. You did the same thing in 87, 99, 2000. And today, we are sitting on a significant amount of cash when the markets are going down. My question is, how do you time the big market moves so well?
We'd like to offer you a job first.
I will take it.
The interesting thing is, obviously, we have the faintest idea what the stock market is going to do when it opens on Monday. We never have had. We have never made, Charlie and I don't think, in all the time we've worked together, and I'll tell you something later on, maybe about how learning takes place, but we have never, I don't think we've ever made a decision that where either one of us has either said or been thinking we should buy or sell based on what the market is going to do. No. Or for that matter, on what the economy is going to do. We don't know. And the interesting thing is, sometimes I get some credit someplace for the fact that, how wonderful it was that we were optimistic in 2008 when everybody was down on stocks and all that sort of thing. We spent a big percentage of our net worth at a very dumb time. and I shouldn't say we, it's I. We spent about $15 or $16 billion, which was a lot bigger to us then than it is now. We spent in the last few weeks, or a period of 3 or 4 weeks, between Wrigley and Goldman Sachs, General, at a terrible time, as it turned out. I mean, I didn't know whether it was going to be a good time or a bad time, but it was a really dumb time. And I wrote an article for the New York Times and Buy American and all these things. Well, if I'd had any sense of timing and waited 6 months until, I think the low was in March. In fact, I think it was on CNBC maybe that day or something. But I totally missed that opportunity. I totally missed, in March of 2020. We have not been good at timing. We've been reasonably good at figuring out when we were getting enough for our money. We had no idea when we bought anything. Well, we always hoped it would go down for a while so we could buy more. And we hoped even after we were done buying and ran out of money that if it was cheap, the company would keep buying, in effect taking our interest up. I mean, that's stuff you could learn it in 4th grade. We haven't ever timed anything. We've never figured out insights into the economy.
So Warren Buffett has said that he doesn't time the bottom. He buys when valuations make sense. He doesn't try and catch the bottom. In fact, he said that before the Lehman Brothers collapse, before all your Goldman Sachs, all your bankruptcies in the year 2000, he was buying on the way down already. And then he published the Buy America newsletter that came out, and then at that point the stock market had another 20% more to go. So for Warren Buffett over here, he can't time the bottom, and so I don't think anyone should be timing the bottom as well. What you should be doing instead is to just try and catch the knife. I mean, all wounds heal anyways, right? So just buy on the way down, and then over the long run, if you're a long-term investor, if you're buying into high-quality businesses, then there shouldn't be a worry about your stocks recovering over time, because likely they will. Last portion over here, I'll be answering some of the questions that you guys have asked. So the first one over here said, hey, great videos. I want to know about your research on ServiceNow, Exxon, Monolithic Power, as well as Cadence. So ServiceNow, I know it's a software business. It is an extremely fast-growing software business, but the problem with it was when I was screening it, when I was looking through it, it was simply just too expensive. Same thing for Exxon. So Exxon is a defense company. I believe what they do is they sell all your defensive gears and all that. But for Exxon over here, it is trading at around a 20 times or 30 times price to sales. I'm not too sure what the valuation is right now. But yeah, the valuation just doesn't make sense, and that's why I haven't invested and I haven't looked too much into these two stocks over here, which is your ServiceNow as well as Exxon. As for Monolithic Power, I believe they do some sort of power generation for your data center. And for me, I stay out of data center stocks because data center stocks, they are way too cyclical. They rely too much on the data center boom. And once the data center boom starts to slow down, then that is when you see all these different companies getting hurt. As for Cadence, it is a company that I believe it's in a duopoly with another company called Synopsys. For Cadence and Synopsys, I have looked into the business before. Cadence is a lot more high valued. Synopsys is a lot lower value. In fact, Synopsys is probably the better buy right now, but for me, I simply don't understand the business. I've tried looking into Synopsys, looking into what they do, but I can't understand the thing, and that's why I haven't invested in Synopsys or Cadence. Next one, please analyze Novo Nordisk. It's good value right now. I have 750 shares. So Novo Nordisk, it's a quality business, but the problem with pharmaceutical companies is they face too much scrutiny. So you have scrutiny in terms of regulation, in terms of prices, in terms of cross-border selling and all that, and in terms of all your different shortage productions and all that. So for Novo Nordisk over here, it's a company that is facing a lot of threat because if the tariffs come in, then your pharmaceutical companies from abroad will get hurt as well because the US will try and secure the pharmaceutical companies in the US. And for Novo Nordisk over here, they face a lot of competition. In the future, all your different weight loss drugs, they'll become commoditized, and that is when you see Novo Nordisk and maybe Eli Lilly and all your different other companies like Merck, Pfizer, they'll start fighting and competing over cost. That is not what you want to do. But for Novo Nordisk, I think for the next 2 to 3 years, it will definitely be safe because the patent only expires in 2031. If you're looking to trade this company for the next 2 to 3 years, I think it is a decent buying opportunity right now. In fact, I think it is quite undervalued. Last question. Hi, I'm a new subscriber to your channel. I really respect your analysis. I wonder if you look at the small cap stocks like stocks found in the Russell 2000. I have no problems with mega caps, but I like to look at stocks that might be bought up by another company. Okay, so here are some of my thoughts about this sort of like investing strategy. So for me, I look at high quality businesses. I don't want to sort of like buy a company that is trying to exit and trying to sell out their business and all that. As for stocks in the Russell 2000, I think there are some small caps that are quite reasonable right now. For example, one of it is SiriusXM. SiriusXM is I believe it's a small cap as well. It is currently trading at a decent valuation. In fact, it is trading at a very low valuation. So that is one that you can look into as well. Although it is in a sunset industry, but it is a stock that is extremely monopolistic in its field, and it's a stock that Warren Buffett bought as well. It's a small cap. That's all for this video. I hope you guys have found this one useful, and please invest safe.